Good afternoon, everyone. Those who are with us here and those who are with us through the webinar. We are broadcasting this through webinar, so a number of questions, a number of participants are going to listen and go through the presentation with us. My name is Nasser Spear. I'm Deputy Dean, Melbourne Business School. And today, the aim is to give you an overall overview of all the program and services we have at Melbourne Business School. I understand that you are aware that we will focus today on accounting and finance program, but I think it's still a good idea to be aware of the whole portfolio of program we have on offers. And I'll also speak to you about scholarships and the entry requirement and some deadline and fees along that line. We also we will have with us Associate Professor John Hanley, who is the head of the Department of Finance, talking to us a bit later about the financial crisis of 2008. John is just there. And we also have with us the acting head of the Department of Accounting, Professor Naomi Soderstrom, who will talk to us about an accounting story. We're yet to find out what that story is about. And then I will have a question and answer after I finish my part, and then we'll have another set of questions and answer after the presentation by both John and Naomi. We also have with us Greg Schwan, who is the Program Director for the Master of Management with Finance Specialization. And we have a number of colleagues from the selection admission team who are around here. And of course, at the end, we hope that you can join us for food and drinks around. All right, so with probably in total, the presentation along my presentation as well as the presentation by both John and Naomi and the question and answer, we hope to finish by about 7:30. So everybody is aware of the timeline. All right, so let's start with the main question. When you're considering graduate school, it's always the question, why should I join this particular school? And I think, and I have, as a graduate of a graduate school, both in coursework as well as research, I had to go through this question myself. And it's always important when you join graduate school that you really do your homework quite well in terms of starting by asking a question, what this school is about. So I want to talk to you about what's the mission of Melbourne Business School. We are here to try to enable individuals and organizations to make an impact. And that impact, of course, will transfer into taking leadership position, both locally as well as globally. And we make this happen through the creation, that is through our research activities, and through the application, through many of the programs that we run, through our consulting, both to local and global business and government, and dissemination that happen through student body as well as other academic colleagues and journals and the like, in both areas of business economics. So we're looking for people who are trying to make an impact, and that will come when we talk to you about the selection process of the student who join MBS and the type of student you will join should you join MBS. These are the people who are here to make an impact in whichever discipline they are enrolled in. We measure our impact through tracking of how we stand in terms of certain ranking. The ranking themselves are not an end, but rather as a measure. You can think about it as how we track as competing against ourselves. How do we track over time in terms of how we stand on key measures of the ranking? These are value for money. These are impact. These are employment outcome, productivity in terms of research productivity, in terms of the caliber of the student and the graduate, and the international reputation of both the university as well as the business school. So as you can see here, we do quite well in many of these rankings. And I think in general, we're blessed here in Australia that many Australian universities sit in the top 100. So it's something I think we should all be pleased about. But I'm pleased as well to note that we also track quite well even among that elite group. And you can see for both discipline-specific ranking as well as overall business economic and University of Melbourne at large. The program that we have in offer, we do have coursework and we have research program, as any graduate school will. The program probably can be divided into those that cater for recent graduates and early career, such as you just finished your bachelor degree or just had 1 or 2 years worth of experience, and for those programs that are catered for people with significant mid to significant work experience. So we have program for people 3 all the way up to senior executive number of years of experience. We offer, most of our programs are delivered on campus. However, you'll find plenty of blended learning opportunities taking place throughout our subjects at different levels. Different subjects incorporate the blended learning opportunity at different capabilities and different interests. But we also started delivering some online program, fully online program. So as of next year, we're launching our first online program, and that is something called the Graduate Certificate in Business. And I'll speak briefly about this later, and we hope to deliver more online programs moving forward. So briefly speaking, I'll start by talking about the early career coursework program. Probably the main suite here, we have the Master of Management. So Master of Management is a suite of programs with multiple specialization that cater for 2 groups of students. If you are a graduate of science, art, music, any area that's non-business and economics, and you want now to convert and try to study into business economics, the Master of Management is your first stop. And that Master of Management, you can take specialization, accounting, finance, as you see before you, management, human resources, marketing, or you can do as well multiple specialization or combined specialization. The length of the program for if you don't have cognate background is 2 years. But we have a group of students who finish Bachelor of Business or finish Bachelor of Commerce, but say they specialize in marketing, and now they want to specialize in accounting. So they can move to the Master of Management and specialize in accounting, and but the program will be a bit shorter. It will be 1.5 years as opposed to 2 years. So the length that you see here between 1.5 to 2 years is really a function of your academic background and what elective you wish to choose. As you can see, some of the programs, if you want to do double specialization in accounting and finance, we have a condition that you have business background to join in and do the 2 years. However, if you still want to do double specialization and you don't have business background, it just means the program will be a bit longer for you. That's always possible. We also have, similar to the Master of Management, the Master of International Business, which is which focus on as well for early career professionals, but all aspects of international operations of any global organization, from investment to management to HR to marketing to taxation and so on. And again, the length of a program function of your cognate background, whether you come with business background or non-business background. Now, for those who have Bachelor of Commerce with particular specialization and they want to advance that knowledge in that specialization. So say you finish Bachelor of Commerce with a specialization in finance, and you want to learn more about finance, and you want to advance your study in finance, then the program that's available for you is the Master of Finance. So as you can see, these programs all assume discipline background in the field. And still, the lecture program is 2 years. You're getting advanced knowledge in that discipline area. So Bachelor of Finance or sufficient studies within your Bachelor of Business in Finance will qualify you to join the Master of Finance. Same thing for the Master of Economics, and the same for other discipline, as you see, other area, whether it's applied econometric, actuarial science, or even in other specialist areas such as in the commerce, Master of Commerce, actuarial science, management, marketing, and so on. We also have introduced a number of interdisciplinary programs. For example, the Master of Marketing Communication that is actually hosted by the Graduate School of Humanities. We jointly delivered that program. We covered the marketing side of it, and the School of Humanities delivered the communication side of it, but it's about communicating and PR discipline and work in the PR area. Business analytics, as you all know, it's an upcoming and important area. All right. I'm assuming, so I will just say okay for now. So the business analytics, as you know, data analytics is becoming quite important in any discipline area, whether in accounting, finance, economics, strategy, marketing, and so on. The Master of Business Analytics try to focus on how you can use data and large data to inform your strategy and how your strategy feedback into the data design and the data collection process. So it's a quite an informed, data-informed strategic analysis of your business. Finally, I'll talk a bit about the post-experience programs. So these are people with which you've got significant work experience that vary between, if you've got 3 years as a minimum, all the way up, as I said, to senior executive. So if you're looking about, we've got the MBA suite of program. So for that one, if you are interested in MBA programs, whether it is the full-time or the part-time or the executive, senior executive, for those programs, we do ask that you attend specialized session just for the MBA, and we can give you the dates for those information sessions. We also have Master of Supply Chain Management and Master of Enterprise, also program delivered for post-experience professional, but they are very delivered on weekly block basis, very intensive, and as the title suggests, one is focus of it is on supply chain management, the other one is how to run successful enterprise. For those interested in research or doctoral program, we are the first institution in Australia to have introduced a 5-year doctoral program, and we have rolled this across all our discipline area. So that's in accounting, finance, economics, decision risk, and financial science, management, marketing, as you see, all the discipline area. So you will be doing about 2 years of coursework followed by 3 years of research. Of course, it's quite lengthy process. Probably you could say it's painful process, but I guess we reward you in return by every PhD or every doctoral student we have on campus is by definition a scholarship student. So all our doctoral students are selected only if they meet as well our scholarship scheme, and they are 100% fee waiver scholarship, as well as a significant stipend to cover their living expenses. So it's a quite an engaging, but probably that's jewel in the crown in terms of the achievement, in terms of how we fulfill our mission, in terms of creating knowledge and disseminating that knowledge. All our programs are accredited by the relevant professional body, whether they're accounting bodies or actuarial institute and so on. In addition, the faculty and the business school at large is accredited by the American Association of AACSB, as well as EQUIS, the European accrediting agency, in addition to, of course, to the Australian agency. So we have full accreditation and ensure that we're always programs are up to date, fulfilling our objective and the aim of each particular program, as well as the business school at large. I spoke to you about programs. The other aspect of you need to know about is tell me more about your academics. Tell me a bit more about the type of student that's going to join in the classroom with me. Tell me about your facilities and any other enrichment or employability program or experiential learning program that you have been offered. I've already spoken that our academic have world-class reputation, either because they have taught or because they have studied in some of the top business school and business and economics school globally. The student we select, as you will see from selection criteria a bit later on, we select very high achieving students who are trying to make an impact, and you will find that they share your vision in terms of what they hope to achieve out of their degree, regardless of the specialization. The facilities, we are now in one of the buildings. We are the Melbourne Business School span 3 buildings. There is another building called Business Economic Building next door, and then that's attached to that is the library, and there is the MBA suite of programs are delivered in another building across the road. We've got large number of lounges, student lounges, computer labs, as well as the library. I encourage you to visit even as you leave tonight. It's quite an impressive place. In terms of the enrichment and experiential learning program, that's where I will focus a bit over the next few sessions, the next few slides. So it's not moving. It's coming into slow mode. All right, I'll make a start as Katie tried to. So sometimes frozen for some reason. Froze. Completely froze.
Yeah.
Okay.
Yeah, we'll just wait another 10 seconds.
All right, I'll talk to you a bit about the enrichment and experiential learning program. One of the key experiential learning program is we try to get you, in addition to what you know in the classroom, we need to engage you in learning in the workplace. So we run two particular subjects, and these subjects, one is called Melbourne Business Practicum, and one is called Global Business Practicum, where basically you'll be in groups of 5, hosted by an organization, intensively within 2 weeks, addressing a particular strategic issue facing that particular organization. At the end of it, you present your work to the management of that organization, whether it is in Australia or whether it is in the global destination that is available at the time. And of course, you'll be accompanied by an academic, and you will be assessed based on your meeting the objective of the assignment that's before you. So some of the recent destination, the global destination, we have sent people to Hong Kong, Singapore, a number of Chinese cities destination. We also, in November, sent a group of students to London, and there is talk about as well expanding into other destinations, including more destination in Germany, as well as potentially Israel, some destination to come in the near future. The idea behind it is that you try to get, this is your opportunity to marry theory to practice. This is where you apply what you learn and see it in the real life work environment. All right, here we go. All right, so I just spoke about the work integrated learning subject. In addition, we have mentoring program and internship program. So in the mentoring program, it's quite a large program. We basically assign about 300 to 400 mentor with 300 to 400 mentees, student mentees. Where basically you have an opportunity to exchange idea about your transition to the workforce, as well as advice in general about your engagement and about your maturity as a business professional moving forward. We have a larger and larger number of industry partners coming on board, offering internship opportunities that are available, many of them local, some are international, depending on the agreement we have with them at the time. We also, in the work I spoke to you about the Melbourne Business Practicum, as well as the global one, where I talked about the consulting opportunity, where you work on real-life cases, issues, and this has led, many of these practical opportunities have led to employment, positive employment outcome, because it's your opportunity to impress that organization, and actually many end up making recommendation for their branch organization in another city, so they don't end up necessarily working just in that city, but in other city where that organization functions based on those recommendations. We also run a number of additional supporting programs. One of them is the Personal Effectiveness Program, and there are a number of case competitions that we run. We have the MBS case competition. We have a case competition with the India School of Business, where we compete the top Australian school, compete with the top Indian Business School, and this is rotated between Melbourne University and Indian School of Business every year. We run as well as startup competition, as well as I said, the personal effective program, which is a set of workshop and seminar to enhance your employability skills, as well as your opportunity to join many clubs and societies to expand. Within that, you can your ability to expand your professional network, as well as social network, as well as your engagement with the industry. And many of those clubs and society, they run their own competition in addition to the one we run. Before I go next, this pretty much gives you an idea about all the program and services that we have within Melbourne Business School. To many of these programs, I have to emphasize, like the practicum subject, not every student will get the opportunity to join them. You have to go through interview process, you have to go through selection process, there is minimum GPA process that you have to achieve. So even in some of these initiatives, you have to go through additional academic rigor selection process. To entry, there is a minimum GPA. I will disclose this to everybody. We look for people who have 70% Melbourne equivalent. What's that equivalent in your institution? I will not disclose it. But effectively, we want people who can show strong academic capabilities. But even if you don't, we look not just at the overall GPA, we look at your performance on the relevant subject. So for example, even if you're slightly below that 70% cutoff, but you do have high performance, say, in relevant subject as undergraduate, that will work in your favor in terms of getting an admission to that particular program. We do look as well, we ask people to submit personal statement why they want to join that program and to explain any circumstances that can have affected their studies at the undergraduate level, and any experience and any engagement they have undertook while or during their undergraduate or post their undergraduate. We do look at all of those, not just for the sake of the admission, but for the sake of deciding on scholarships. If you're an international student, you have to submit the IELTS or equivalent. And if you are an international student applying for any of the programs you see before you, Master of Finance, Master of Commerce, Master of Actuarial Science, or Economic and Applied Econometrics, but has not previously studied there or completed their undergraduate in Australia and New Zealand, you need to submit the GMAT or the GRE. For those who don't know the GMAT or GRE, every top business school asks for this. It's a standardized test where it's about 4 hours long, where it tests your quantitative, verbal, analytical skills. And there is a practice, and I'll speak to you about it should you wish, but the average GMAT score for student is about 660, 670 on average. For the MBA, it's about close to the 700, and the GRE or its equivalent there. Scholarship, one of the questions that many students ask about. We are trying to recruit the best and the brightest, but on the other hand, we offer the most comprehensive scholarship scheme, I believe, we have in Australia, if not in the region. Our scholarship scheme range from between 25% fee remission all the way up to 100%, plus stipend for research program. The scholarship are awarded, you don't need to apply for them separately. Your application to join the program, automatically, we assess it for a scholarship, whether you'll be immediately awarded scholarship as part of your application, or you'll be put in a pool to be later decided to compete with others for scholarship. And so no separate application, but the decision is based on academic merit, as well as what you write in your personal statement about your capabilities. We award Commonwealth supported places. Many of the program are Commonwealth supported places eligible, but not all of them. And you could see that the Master of Finance and the Master of International Business are not. For those of you who've been following the budget by the government, probably will not have CSP in the graduate space only in Australia in about 2-3 years from now. So it's probably in its last few years on offer. But we award them on the basis of academic merit as well. Even if you did not receive scholarship on commencement, we do have scholarship scheme for continuing student. So if you are as a continuing student performing at the same level expected of academically at the commencement level, we then review your performance after 4 subjects or up to 8 subjects, and we allocate scholarship. You don't need again to apply. We go through these rounds regularly throughout the semester, and you will receive basically email from us advising you of a scholarship. We also have scholarship that are based on leadership and community engagement. We have scholarship, subject-based awards as well. So really the opportunities are plenty to encourage you to do and dedicate more time to your studies. Application deadlines are before you. For international student, end of October. Local student in November. For those who are interested in the graduate certificate in business, which is the online certificate, the deadline is in January. And you probably need to read more about that graduate certificate in business through our websites. We need your transcript, a personal statement, the GMAT or GRE if required, and the English test if you are an international student who did not complete the prior studies in English or assessed in English. But that's pretty much a full overview of the program. Probably now I open it up for general question and answer before I hand it to John and Naomi to speak to you about stuff, about good stuff. Please.
About the internship program, so is that another subject or something else?
No, the internship are not treated as a subject, so they are taken in addition, but the practicums are subject. Right? Okay. So if the internship, in general, if internship are paid, by definition, we can't count it as subject because of their Islamic.
So it's like, is it offered through the interest?
So we have, for example, agreement with a number of organizations where there will be selection process for some of those internships. Some with organization, we have like 20 internships in that particular organization. Some we have 5. Some are come without agreement scope, outside the scope of the agreement. And basically you will be advertised. You receive weekly newsletter every Monday from us. It's called the School Newsletter, where you get to know about all the opportunity, whether it is personal effectiveness workshop, whether it's event, whether it's competition, whether it's internship opportunity, where to apply, whether it's scholarship, and so on. So that's weekly communication with you.
It's follow all the program functions.
Yeah, follow program. Yeah, correct. Yes.
So I'm just wondering, with the CSP places, are they awarded on the basis of past academic achievement only, or is the personal statement counted as well?
So the personal statement counts because we do treat common separate place like we treat any other scholarship condition. But because we don't have large number of common supported places, so we have to award them on the basis of some kind of merit. So academic merit will come to it, in addition to what's in the personal statement. Of course, we're looking for people who have both, who have got the academic merit and have got the engagement and others. But in general, it has not been an issue in terms of local students receiving either CSP places on commencement, or if they receive one at commencement because their academic merit was slightly below, then they will receive it for being as a continuous student. Any other questions? Yes, please.
In terms of the program, for example, if I'm currently doing an undergrad in accounting, and if I want to do a master of accounting, is that eligible?
All right. So probably I need to answer your question in 2 parts. If you have done bachelor degree in accounting, we used to have a master of accounting for advanced study in accounting. But we have decided to suspend that program because we found many students who come specifically, so students who finish accounting at Melbourne, they end up receiving many employment outcome based on their undergraduate studies. For those who received it in other institutions, they're trying to convert, whether it's international or global or other, then we probably offer them within the Master of Management, Accounting and Finance as potential where they can combine a bit more advanced study in accounting, and But of course, if you have a large number of subjects in accounting, such as specialty in accounting, we don't have a degree to advance your study in accounting. But in finance, we do. So if you have done bachelor degree in finance or sufficient breadth studies in finance with advanced studies in that one, then you could do the Master of Finance.
Because of the time, I used to
yeah, good school.
Bachelor of Business Accounting.
So we'll have to look at what subject you end up taking. We probably will recommend a program that can combine accounting and finance, or maybe, I guess it begs the question, RMIT program is accredited and will qualify you for CPA Australia as well as Chartered the Institute. Then the question is, why do you want to study another master in accounting? So we'll probably then sit with you to course advice about what other options you wish to study. Yeah. Thanks. Any other questions, please? All right. So look, I will be around. My colleagues here in Mission as well will be here. I guess in the interest of time, maybe I now invite John to speak to you about the 2008 crisis.
That's right.
Okay. And apology for the pause in the screen. I have no idea what happened.
Should we just do
So,
this is you, isn't it?
yeah, that's me, and view, oh, no, view, sorry, full screen mode.
Beautiful.
Okay. Okay. Welcome everybody. Yes, not yet. No, that's okay.
Online audience.
Online audience.
Yes. I apologise.
That's okay. Welcome to you too. Oh, there I am. There you go. Disappeared again. Okay, great. Thanks, Hamish. It's great to be here, people. I've been assigned the task of giving a sample finance lecture in about 30 minutes, which is a little bit challenging because normally the classes go for 2 or 3 hours, so I've got much longer to tell the story. But what I'm going to try to do at any rate is to give you a quick overview of the financial crisis of 2008. This was certainly the biggest thing in finance in the last 30 years and probably the biggest thing in finance since the Great Depression. And it's received a little bit of press and profile in recent years with a movie that was basically, which was essentially based on the events at the time. That's called The Big Short. So I don't know if you've seen The Big Short. It's a very interesting movie, and so a number of things that we're going to touch on today formed the basis of that movie. So what exactly are we going to talk about? Okay, so the crisis, what was it? How did it happen? Who was to blame? And interestingly, is it over? Is it over? Right? 2008 sounds a long time ago, but it's not really. And then the final point is, what is the most important lesson to be learned from the 2008 financial crisis, or at least, in my opinion, what I think is the most important lesson to be learned. Okay, here it is. Let's get ourselves in a sort of in a time capsule. Let's imagine we go back in time to January 2008, and we're in a finance class and we're talking about the investment banking industry in the US. And at that time, we would have said, look, there's many investment banks around the world. And in the US in particular. Some are big and some are small, but at that time there were 5 big ones, and I think many of those names would be familiar to many of you: Goldman Sachs, Morgan Stanley, Bear Stearns, Merrill Lynch, Lehman Brothers. Now imagine it's 2008 and I said to you, you know what, within a couple of months there's only going to be 2 left. So either you would have thought I was totally crazy, or I knew something. Okay. Now, it's easy to say this now, okay, but this was the situation. Back in January 2008, very few people would have dreamed that within a short period of time, whoops, it disappeared. Sold that one and sold that one. And so only 3 went out of the top 5. So what was the crisis? Here's a little excerpt that I took from the New York Times. It was in 2009. I love the New York Times. It's a great, one of the world's great newspapers, and I love the language that they describe things in. And this is a colourful depiction, although a very informative depiction of what the crisis was. And it basically says, and I've highlighted a couple of things there which we're going to talk about shortly. So in the fall of 2008, the credit squeeze, okay, so it started with this thing called the credit squeeze, which started a little more than a year before, ballooned into the biggest crisis since the Great Depression, as hundreds of billions, okay, hundreds of billions, that's a lot of cash, in mortgage-related investments, okay, so it had something to do with mortgages and the housing market, went bad. Mighty investment banks, okay, we've just seen 3 of them that disappeared, that once ruled high finance, have crumbled or reinvented themselves as humdrum commercial banks. Now, I don't think Bank of America and JP Morgan would appreciate being called a humdrum commercial bank, but that's what they're referring to there. The nation's largest insurance company, the largest savings and loans, were both seized by the government. Okay, the channels of credit, the arteries of the global financial system have been constricted, cutting off crucial funds to consumers and businesses, small and large. And if I was standing behind an organ, I would now go, duh, 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 right? So this was the setting. So keep in mind, this was written in 2008. So we were still right in the depths of it. Okay, so what was the timeline? If we had more time, we'd talk about each of these points, okay? So I just want to highlight a couple of things to indicate. The previous slide suggested, you know, it started 2008, 2007, but no, really, a lot of people think that it started at the turn of the century, 2001. And there were 2 main events that occurred there. The US government adopted this policy issue that they wanted to encourage home ownership, okay? They thought that there were not enough Americans who own their own homes. So they put in place a number of policies which basically made money easy, okay? It was easy credit. It was easy for people to go up and borrow money to buy homes. The second thing was, around that time, we had what was called the tech boom and the tech bust, okay? So markets went up and then they crashed, and the US Federal Reserve was very concerned that the US was going to slide into recession. So what they quickly did is that they cut interest rates very, very dramatically. And so what that meant was we had an issue, or we had this combination of a government who was prepared to effectively facilitate lots of money being available to people to buy homes, and low interest rates. And so what do you think that did to the housing market? It started to fuel a housing boom, and prices started to go up and up and up and up and up until, bang, what goes up must come down. And so around about the start of 2007, the housing bubble burst, right? And then that sort of started off over the next period, this red period, okay? And the red there is important because that's the blood, okay? That was the financial blood that hit the floor, and it particularly hit the floor in this period from, and you can see it's a period of 7 days. This was just absolutely catastrophic in financial markets. Started in the middle of 2007. One of those investment banks, Bear Stearns, they had a couple of hedge funds which had a large exposure to the housing market and some of these fancy securities that we're going to talk about shortly, and they collapsed. And Bear Stearns hung on for about another 9 months or so until they had their backs up against the wall, and the Federal Reserve stepped in and basically said, we can't let Bear Stearns basically collapse. So what they did is that they essentially, let's say they strongly encouraged JP Morgan to buy Bear Stearns. So there goes the first one, Bears is gone. Okay. And then everyone's watching financial markets. In September of that year, 2 of these government organisations which were involved effectively in facilitating this easy credit in the housing market, Fannie Mae and Freddie Mac, they were going to go bust. So the US Treasury just said, no, you guys are finished. We're going to seize control of you. And then the week really started. Merrill Lynch, okay, they saw the writing on the wall. They also had this big exposure to to the housing market and these housing-related securities, and they said, well, we're in trouble, so we better sell ourselves to Bank of America. And then a critical turning point occurred the next day. Lehman Brothers was also going to go underwater, and the government said, fall, you're gone, we're not going to step in. Now, this is shareholders in that company, you know, you are exposed to risk. You can't expect just to have the good times and have the government come in and save you during the bad times. So Lehman's fell, okay? So effectively the government stepped in and saved Bear Stearns, if you call that saving them, but anyway, but Lehman's fell. 2 days later, AIG, which is American Insurance Group, America's largest insurance company at the time, they were on the brink of collapse, and the government said, no, they're too big to fail. We've got to save them. So they effectively seized control, and a lot of taxpayers' funds were basically used to save them. So they were bailed out. Then there was this series of stimulus packages. Okay, so there was this crisis in financial markets, which was then going to permeate into the wider economy. And so governments in the US and also globally, they started to basically adopt policy decisions, stimulus packages, which was meant to basically ensure that the economy did not go into recession, let alone into depression. And basically, since that time, the US economy has been pretty anemic. Okay, the interest rates are really low, but the economy is just petering along. So essentially, whilst this was the period of all the action, the US economy still hasn't fully recovered from the shock that happened there. Now, it is slowly coming back, but this is why you see, you know, every couple of months when the Federal Reserve in the US meets to decide whether they're going to lift interest rates or not, this is why they're so cautious, you know, insofar as the economy is sort of showing signs of recovery, but it's still not there. Don't get confused with the stock market, right? The stock market has gone through the roof, and certain people in the US are putting their hand up saying, hey, that's all due to me, right? But what that really is reflecting is the fact that money is cheap. Okay, money is cheap, interest rates are low, people have poured money in the stock market. So this current state of the stock market is just, you know, giving you a false message of how strong the economy is. Here, there was a major problem with Greece. Okay, so here's the third thing to notice, 2017 plus. Okay, so there was a major problem with Greece, and notice here, I'll get back to the end shortly, Greece, and there's something happening in China, which is not particularly good. All right, so before we get into it, we've got to cover just a couple of quick background concepts, and depending what your background is, you may have come across a couple of these concepts before, one or two of these concepts before, and maybe not. So I'll just focus on a couple of the key ideas that I want to mention here. So first of all, we've got this financial security known as a bond. Okay, now the idea with a bond is that it's used to raise money. And essentially what happens is that the borrower or the issuer then makes a promise to make certain cash payments to the investor over time. Okay, so the important thing to notice here, right, is that these cash payments in the form of interest and or repayment of principal, it's only a promise, right? The other thing to note is that bonds take on different forms and have many different names. So here's 29 of them. Right? Here's 29 of them. There's probably about another 100 different names for these types of financial securities. The ones that I've highlighted here is basically to point out that they are a form of debt. No matter what you call them, they're debt. And the ones that play quite a role in the financial crisis are things called MBSs, CDOs, CDO squareds, and effectively mortgages. Okay. So the two things to take from that is that when we have these financial securities, whether they're called bonds, MBSs, or whatever, okay, the borrower has promised to make a payment, okay, but it's only a promise. The second thing is that no matter what you call it, it's debt. What's next? Credit risk. All right. So if the borrower has made a promise to make these payments, what's the risk that the borrower defaults on the promise? Well, that's referred to as credit risk, and that's a very important feature of investing in bonds to investors. Right? They're happy to invest in bonds, but they want to know whether they're actually going to receive the cash flows that are promised to them. And so there's an entire industry out there called the credit rating industry, which assigns credit ratings to reflect how risky these particular bonds are. And this is from the three main, excuse me, the three main rating agencies. Three biggest rating agencies are Standard & Poor's, Moody's and Fitch. This is just the long-term ratings used by Standard & Poor's. And you can see that we start at AAA. Okay, AAA says that's the highest creditworthy or the lowest credit risk security. What it says here is it says there's an extremely, or at least in Standard & Poor's opinion, there's an extremely strong capacity to keep its promise. Okay, then we go down to BBB. There's an adequate capacity to keep its promise. Down to CC, it's highly vulnerable. Down to D for default. Okay. Pop quiz 1. I've got 5. How many? So AAA rated. Okay, so we use AAA in just normal, normal language, right? AAA means prime. How many US corporations do you think are currently AAA rated? Okay, there's thousands of corporations in the US. How many do you think? Just yell out a number for me.
3.
How many?
3.
3. Gee, that's good. 2. There's only 2. Okay, and back in 1980 there were only 60. Okay, so in the US, okay, so the rating agencies rate governments and institutions, and they rate companies. So I think that's quite fascinating. There's only 2 corporations in the US which have a AAA credit rating: Johnson & Johnson, Microsoft Corporation. Okay, the other thing, credit default swap. If you've seen the movie The Big Short, these pop up a lot. Okay, it's a type of derivative. You can think about it as being like a type of insurance contract. So what happens here is that if you buy one of these CDSs or credit default swaps, what you do is that you pay an amount, a fee, think of it as a premium, normally quarterly, to the credit default swap seller, some other party. And what you're doing is you're basically buying insurance on this bond. In other words, you keep on paying that, but if the issuer on the bond, so if the credit default swap is related to some underlying bond, if the issuer on that bond defaults, okay, then what happens is that the CDS seller promises to make good the loss. Okay, so this is like a form of insurance. You pay an insurance premium to some insurance company, and if you need to claim on that, they'll then pay you that, or they'll make good the loss. Now, what these credit default or what these credit default swaps or these CDSs allowed organisations and investors, hedge funds to do was that not only were they useful to allow investors to actually hedge the credit risk, okay, by an insurance contract, but also it allowed parties to speculate on the credit risk. Okay, final thing. Securitisation, it's a form of financial engineering, it's a financial structuring technique, and effectively what it does is that it describes when you've got one set of the promised cash flows on one set of bonds or from some other separate source is used to exclusively service the cash flow payments that need to be made on another set of bonds. Okay, so we've got this set of bonds and that makes payments to this other set of bonds which then makes payments. So that's essentially at a very high level what securitisation refers to. And this was the bad guy, right? This was the thing, the misuse of securitisation was the thing that almost blew up the financial system in 2008. Okay, so it wasn't new. Okay, just to show you that it wasn't new. Okay, in 1997, there was a rock star who had what he did was that he decided to securitise his future music royalties, and he raised $55 million in doing so. Okay. Does anyone know? Does anyone want to guess who that might have been? Unfortunately, he passed away this year or last year. It was David Bowie. It was David Bowie. So this deal, it's a great little deal. These bonds that were created out of this are called Bowie bonds. Yeah, they were rated A3 by Moody's. Okay, he managed to raise $55 million in the process. What he did there, that process was effectively the same process as what happened in the crisis, but it was misused in the crisis. So what was securitised in the crisis? Okay, so we mentioned that the government, the federal government, made money readily available to lots of borrowers, right? Now, some of those borrowers could afford to make, could effectively had good credit standing themselves. They were high quality borrowers, but there was also a lot of low quality borrowers, and those low quality borrowers are called subprime borrowers, and the loans that were made to them are called subprime mortgages. Okay, so what happens? the banks made all these subprime mortgages, but because they're, let's call it crappy loans, right, the bank didn't want them on the balance sheet because they were too risky. So what the bank did is they basically went to an investment banker and said, listen, we've got all these mortgages on our balance sheet, how do we get rid of them? Because you can't sell them, how do we get rid of them? And the banker said, have we got a deal for you? What we'll do is we'll set up an SPV, special purpose vehicle. Think of it as being like a shell company. And what you can do is that you sell the mortgages into there and we'll give you the money, right? And so they're off your balance sheet. The bank said, hey, that's great, but if this is a shell company or a shell company, there's no money. Where does it get the funds to pay? All right, well, the investment banker says, what we'll do is that will issue these new securities called mortgage-backed securities. And that will raise money from investors. So the money that investors pay to buy these securities will be used to buy the subprime mortgages. And the bank said, hey, that's great, I'm happy. The loans are off my balance sheet. The investors are happy because they've got these mortgage-backed securities, and these mortgage-backed securities, they were sold as low-risk, high-return securities. Low-risk, high-return securities. Okay, we'll come back to that because that doesn't make sense. Right? So they were happy, and of course the investment bankers were happy. Why? Because they get a fee. And so what happened was that this just then went out of control. They didn't do it once, or twice, or 3 times. There were hundreds and thousands of these things that were actually done. So that's what happens on the setup, right? So effectively, this SPV now owns these mortgages, right? So this is what happens over time. So we've got this pool of borrowers, and so these are the people who own the homes, and they make mortgage repayments. So the mortgage repayments then go into this SPV, and that SPV then distributes the cash flow to the investors. Now notice here we've got just an MBS, all right, the mortgage-backed security. Well, there were basically 3 or 4 levels. We had tranches. It was split into different tranches of credit quality. We had AAA tranche, okay, the highest quality securities, the middle quality securities, and then we had this residual sort of stuff. And it was the rules of how the cash was passed through is very complicated, but effectively what happens is as the cash comes through, the AAA guys get paid first, and once they've got their interest, then the BBB gets paid, and once they've got their interest, then it comes down to here. Now, in addition, what happened is just to provide some insurance on receiving this payment, there were some CDSs that were bought on this. Okay, so this was quite good. The AAA tranche, they were easily sold because they were marketed as low risk, high return. Okay, but the BBBs, they weren't easily sold. Okay, people saw them as having too much risk. So someone in their absolute brilliance said, you know what? We've got hundreds of these different tranches of BBB mortgage-backed securities just sitting out there that we can't sell. Why don't we securitize them? So they basically did that to them. Okay, so you can see here that what we've got is that the mortgages were securitized to create the MBSs, and then this relatively illiquid high-risk group of mortgage-backed securities, they were securitized. Okay, so again, we've got this pool of MBSs, and what happens is that they go to this special purpose vehicle, and then they go to service these other securities, and these other securities are called collateralized debt obligations. You try to say that fast 5 times, and I tell you what, your tongue will trip over your tongue. Okay? But again, AAA, BBB, and residual. AAA, easy, because it's AAA. Everyone wants a AAA investment. BBB, no one wants it. What are we going to do? Hey, let's securitize them. So they did it again. They got lots of BBB CDOs, okay, and again they securitized it and they created another group called CDO squared. So basically what we've got here is we've got this pool of subprime low quality mortgages which is being used to service mortgage-backed securities, which is being used to service CDOs, which is being used to service CDO squares. So, okay, and then it was even worse, right? Then it was even worse. So someone thought, we've got all these credit default swaps out there, why don't we securitize them as well? And they did, and this created what's known as synthetic CDOs. What's the fundamental problem here? Too much leverage, right? This is debt on debt on debt. Now, this isn't just different types of debt, this is debt on debt on debt. So, what do you think happened when the housing bubble burst? This is a classic example of follow the money, right? So when the housing bubble burst, the people who had borrowed for their mortgages, they couldn't meet their repayments. So there wasn't enough cash coming through to pay the mortgage-backed security holders. So there wasn't enough cash coming through to pay the CDO holders. So there wasn't enough cash coming through to pay the CDO squares. Okay? So this just came tumbling down in a load of, I won't say what, but it came tumbling down. What happened to prices? Just sort of conscious of time. This is basically just saying house prices went down and the credit risk and the cost of insurance went up. Okay, so markets were in big trouble. Who was to blame? I'm not going to discriminate. I'm going to blame everyone. Everyone was to blame in some way. There were multiple failures. First of all, the US government was to blame. Okay, it was a great noble policy for to want everyone to own their own home in the US. But the sad reality is that not everyone can. Right? They don't have the capacity. The second one, some borrowers sadly borrowed beyond their means. Right? This housing boom that was fueled, prices went up. Okay. Whilst there's a lot of speculation in that particular market, there were some people who sadly, right, they borrowed money to buy a home and they couldn't afford to make the repayments and they lost it. That's the human side of the tragedy. The rating agencies, okay, they had flaws in their credit models. They had problems with the way that they modelled default. They had problems with the way that they modelled recovery rates. But here's the indication of the problem, right? So, how many AAA rated companies in the US are there now? 2. How many were there in 1980? I think on the previous slide. Yeah. Not that many. Okay, so back at this time there were probably 5 to 10 US corporations rated AAA. Now, we saw that there were AAA rated MBSs, CDOs, CDS squares. How many of them do you think there were? 60,000. And what were they supported by? A pool of crappy mortgages. Okay, so something went wrong. Something went wrong big time. The banks, they had this is a classic example of moral hazard. If a bank lends you money and is going to keep that loan on their balance sheet, they're going to conduct really solid due diligence. But if they're going to lend you money, take a fee, and then sell that loan to someone else, the issue about default is someone else's problem. Okay, so the structuring of the system was wrong. Investment bank, they just had the incentive just to churn and burn this. They had the incentive to pump out as many of these securities as possible. The regulators were too slow. The CDS sellers, okay, this credit default swap, this insurance policy, it didn't actually eliminate the default risk. Think about this. If you have an insurance policy that is only as strong as your insurance company, right? And so what we had here is that a number of these people who effectively, or these firms that effectively sold these insurance policies, okay, they overextended themselves. They didn't have enough capital. Some investors lacked a reality check. Okay, one of the fundamental paradigms of finance is the higher the risk. The higher the return, the higher the risk. Okay, now this was being offered as high, when we say return, high expected return, low risk. Okay, something's wrong. Okay, if it's low risk, it should be low return. If it's high risk, it should be high return. Something was wrong there. And then the leverage, as I said. If you haven't watched the movie, you can get on YouTube and you can see some great little clips of this. This is just a clip. I'm not going to show it now, but those of you who have seen the movie, there's a great scene in a sushi restaurant where you've got the CDO manager trying to explain to the Steve Carell fund manager character about this leverage on leverage on leverage. And then for some strange reason, you get this scene with Selena Gomez sitting around a blackjack table. But anyway, it's a good movie. All right, the aftermath. Right, so a lot has been written about the financial crisis of 2008. Here's 2 little editorials that I picked up for a reason that I'll tell you in a moment. It says, after such a panic as has the past year swept over the country, it becomes a kind of melancholy pleasure to look over the field and find that there are not quite so many dead and wounded as anticipated. It was a fearful storm whilst it lasted, an attempt to do too much with too little capital, right? Too much leverage. And this here. So here it's talking about it wasn't just a single sort of reckless trader like a Nick Leeson who brought down Barings Bank or the like. all wild speculation, but the wrong financial system. And I think that really summarises what the crisis was about. And the reason why I chose them was that they were written in 1874 and 1876, and they could have been written in 2010, 2011. So what is that telling us? Well, first of all, why were they written in 1874, 1876? There was a big financial crisis in the US during that period of time. What was the tech boom industry in the US in the 1850s, 60s and 70s? It wasn't computers, it wasn't the internet, railways, right? Railways, expanding the railway system. That needed to be financed, and so there were all these fancy financial securities that were issued, convertible bonds, a whole range of different things. And there was a big crisis there, lots of defaults. Okay, so what this was basically saying was that period of time, too much leverage, bad structuring, bad incentives, etc. Boom, go forward 130, 40 years or whatever, same story. History repeats. There's a lot of lessons to be learned from finance. So, key takeaway, this is what I think the main message from the crisis is. It was all about risk. The markets, investors underestimated risk. Okay, so what was happening here was that people were prepared to sort of go by with this, yes, let's securitise all these particular securities. We'll call them AAA rated securities. We're effectively borrowing way beyond our means because the housing market's going up and we're never going to lose. Well, that's when risk becomes very important. Right? So never forget about risk, particularly when markets are going up. Final thing, is it over? Well, strictly it is, although, as I said, the economic consequences of it are still being felt in the US. What's happening in Greece? Well, Greece is in trouble, right? And you would have seen this over the last few years. The problem with Greece is that they've got too much debt and they can't pay it off. The reason why they can't pay it off is because they don't control their currency. Okay, the currency, Greece has adopted the euro as the currency. And who controls the euro? Well, effectively the European Central Bank. And who has most say in that? Well, the Germans and the French. Right? So you've got the weak European economies like Spain and Italy and Greece, and you've got the strong economy. So there's what's happening here is that you've got a lot of politics associated with the economics of it all. So this was just a clip, or this was just taken from the Wall Street Journal only a couple of months ago. It's still going. It's still going. Basically, what's happened here is that someone is sitting on a big loss, and it's basically playing past the parcel at the moment. There's all these Greek bonds out there which really aren't worth much, right? And that sort of loss has not been realised at the moment. What's happening in China? Okay, so this is again some quotes from this year, right? So China, the Chinese banking system is huge, right? But it's actually bigger than the official banking system. There's this thing called shadow banking. So there's lots of lending going on in China, which is effectively unregulated. And the challenging thing here is that we don't really know how much is out there. Okay, so the problem is if there's a crisis in that shadow banking system, then that's going to hit the entire Chinese economy, and then that's going to hit the world economy. And so much so that Moody's, only this year, they downgraded China's credit rating for the first time since 1989. Okay, so what they're saying is the level of credit risk has gone up. Okay, so these two aspects, right, Greece and China, are not strictly the financial crisis of 2008, but this might be just an indication of something repeating again. And the cause of all financial crises is just too much debt. Okay. Naomi.
Thanks very much, John. After the accounting session that we've got now, the selection and recruitment team welcome your questions over a little bit of some beverages and some snacks as well at the end of this session. So I am delighted to present Professor Naomi Söderström from the Department of Accounting.
So I was in the States during the financial crisis, and I was one of the lucky ones who took advantage of buying a house after the prices went down.
For
So
every loser, there's a winner.
exactly.
That's the face of a winner if ever I've seen.
Good evening. So today what I want to do is give you an example of an accounting lecture. And this is one of the first lecture that I give in my capstone subject in the Master of Management in Accounting and Finance. And the idea is for a capstone is to pull together all of the things that the students have learned in their coursework up to that point, and to basically be a transition between the academics that they've been learning and moving into the workforce. So what I want to do is give you an accounting story. So a lot of people, when I come up to them at a cocktail party and I tell them what I do, I can see the sinking feeling that they get when I tell them that I'm an accountant, because this is what they think of accountants. They think that they're just bean counters, and all we do is we sit down and come up with new debits and credits, and that what we do really isn't providing value or isn't very interesting. And so what I'd like to try to do is tell you a story to convince you otherwise. So what really is accounting? Is it just bookkeeping? Well, actually, there's a lot going on in accounting. You can think about accounting as having an internal focus, which would be looking inside the organization and trying to figure out what kind of data managers need to make better decisions. Or you can think about it as having more of an external focus. So think about providing information for investors, for creditors, and other external users of accounting information. You can think about focusing on recording and reporting, so recording transactions and reporting them in financial statements or in reports for managers to make decisions. Or you can think about planning and control. So we also think about things like budgeting, and we think about how do you design compensation systems to give managers the right incentives so that they're going to help achieve the company's strategy. And what I've got here are the various courses that we have in the Masters of Management, Accounting and Finance, where we talk about different aspects of accounting. You can see I put them in different places kind of to signify what is the nature of accounting within those classes and whether they're looking at internal or external focus, reporting, or planning and control. Well, what we're going to be talking about tonight is what we do when we get out there in the world and are doing accounting. Fundamentally, what we do in accounting is we're providing information for decision making. And there are a lot of different aspects in every setting that have accounting flavors to them. And that's what I'm going to talk about. So why is this important? Well, when you get out after your degree and you're out working, there's not this nice boundary of those nice boxes that I showed you when I showed you the different courses. So for example, if you're a chief financial officer, an audit manager, or a managing partner, if you're a manager, you need to understand the kinds of systems that are in place that help ensure that the company is doing things to implement strategy. And accounting and management accounting plays a role in that. If you're an external auditor, you can't just ignore the way that the numbers are created, because the way that the numbers have been developed is going to have an influence on the way that you conduct your audit. Shareholders are increasingly wanting to get more inside the firm and have a say on what's going on inside of the organization. So, for example, they want to know, how are CEOs being paid? Can they have a say on how CEOs are being paid? So in many countries now, there are say on pay voting possibilities for shareholders. So they want to get inside the organization and understand these incentive systems. And financial reporting is taking on a more integrative perspective as there's more and more demand for sustainability-related information. We're seeing that a lot of company financial statements are becoming more integrated and including some non-financial types of measures that we've been talking about in management accounting for many years. Okay, so what I want to do is show you a case that illustrates how all of these different aspects come together in a single setting. So what I'm going to talk about is Mazda and what to do about that sinking feeling. Okay, so Mazda, sorry, I'm American, so I say Mazda. It's Mazda? No, it's Mazda. You guys are wrong. Because Mazda is a third owned by Ford Motor Company, which is an American company. Now, Mazda had a really difficult problem. In late July 2006, they got some notification from a shipping company that a big container ship that was carrying about 4,700 vehicles had a problem off of the coast of the US and Canada. So what happened was the following. So if you have a container ship and you bring it into waters in a new country, you want to be sure that you aren't bringing in any foreign algae or microorganisms or anything like that into the country's waters. So basically, you sit just outside of the boundary of the international waters and you blow out your ballast so that you get rid of all of those things that you brought in from wherever you came from. And then you can fill up the ballast tanks with seawater again, and then you can go in and enter the country. Well, what happens if you don't do it right? So what happened here is you've got 2 ballast tanks, right, one on each side. What happens if you only blow out one of the ballast tanks? It tilts, right? And that's what happened to Mazda. So this was a mistake that some operator in the container ship made. So this was a problem. The ship was ended up tilting at a 60-degree angle. So this is what the ship looked like. Okay, this is a fly-on. So, you know, there are 4,700 cars inside of that ship that's sitting at this 60-degree angle. You can imagine that Mazda managers had a very large sinking feeling in their stomachs when they heard about this. Okay, so this is the press release that Mazda had, and the important part is actually it just describes what happened. And let's see, oops, wrong one. So the important thing is that Mazda's going to wait until the situation has been fully evaluated and understood before disclosing information other than the fact that it happened. Okay, so we're kind of sitting there trying to think about, okay, what's management going to do? So let's see what happened. Well, they first of all had to recover the ship. And the recovery effort, it was a big deal. You know, you've got this huge container ship that's tilted at 60 degrees. Cars are in there, strapped in, but cars are in there and they need to try to right the ship and see what's happened to the car. So it took 3 weeks. This was not a trivial thing to do. It cost the company $10 million. It was a really dangerous operation, so I don't want to belittle what was going on. This was a really serious operation, and someone lost his life because it was a very dangerous operation. Now, miraculously, if you look inside the boat, the cars, pretty much all of them were still strapped into place. So you look at them, and they looked just, you know, if you tilted your head, they looked fine. Because they were just sitting there strapped in the way that they had been when they were packed. Okay, now, the salvage team had to be really careful because they were really worried of what would happen if they were trying to right things and one of the cars came unstrapped. It could just do like a domino effect through the entire container ship. It could cause enough damage that could potentially sink the ship. So this is one of the reasons why it took so long. Okay, finally, 3 weeks later, the Cougar Ice made it to port in the state of Oregon on August 12th. Now, the good news is that 99% of the cargo was intact. So we had a lot of cars, you'd look at them, perfect looking, they were still strapped in place, looked beautiful. And the good news is that the boat was fine, it was recoverable, they could go get another load of cars, and there was, you know, thank goodness, no environmental disaster. Okay, what about the cars? Well, it turned out it wasn't just one kind of car that was on board. There were a variety of kinds of cars, and Autoblog, which is an automobile industry publication, estimates that the value of the cars is $103 million. Not a small amount. Okay, and if you divide by the number of cars, it's approximately $22,000 per car. Now, I'm an accountant, and we're talking about accounting, so we've got to think about numbers and timing. So remember that 22,000. Okay, 22,000 per car. Okay, what happened to the cars? This is what the cars looked like. They look fine. Looks like you could just go out and get in one and drive it off. It looks like a new car lot. Well, what happened to them? Well, so they're sitting there, and Mazda started getting some calls from people who had ordered the cars because, as you probably know, when you buy a car, if the one you want isn't exactly there, you order it and then it gets shipped. Well, that's what all of these cars were. So there were a lot of calls from these people who had bought cars and were wondering if it was their car. that was on the Cougar Ace. There were other calls as well. So there were all kinds of people saying, hey, this is an opportunity. It's like me buying the house, right? So it's, you know, these cars are going to be cheap because here they've been tainted because they were in the Cougar Ace, even though they look perfect. You know, maybe we can get a deal. So let's offer Mazda to buy the car at a discount. There were some other interesting calls. They got calls from fire departments and from Hollywood producers and other charities seeking the damaged cars. Now, why did they want the cars? Well, fire departments, okay? Firemen need to learn how to put out cars that catch fire, right? So if there are these cars and Mazda doesn't want to sell them, they can give them to the fire departments. Great practice for the firefighters. You set them on fire, firemen put it out. It's great. Hollywood producers. Think about all those movies where there are all of these cars that are in the chase scenes and they get bashed up. And the Hollywood producers would love to get some of these cars that, you know, they look perfect and, you know, we can bash them up because they're tainted cars from the Cougar Ace. There are also calls that I don't have here, are driving instructors and shop teachers. I don't know what it's called here, but you know, kids in high school learn how to work on cars. And so the kids could get the cars and then they could work on them and then make them drivable. Now, this is only a problem because the cars are there. If all of the cars had just sunk to the bottom, if Cougar Ace had sunk, there would have been no problem because they would have been covered by insurance. You know, that would have been the end of it. But instead, now Mazda management has to figure out what to do with all of these cars. Okay, and there were, at this point, 4,635 cars. Now, you could store 4,635 of these things pretty easily. 4,635 cars, not so easy. Okay, so remember accounting. So we need to think about the dollar amounts. And the timing is really important because the way that we disclose information is going to be based upon when we know information and what we know. So let's take a look at the timeline for what at least it appears that we know from Mazda's perspective. Okay, so on the 24th of July, we learn about the accident. On the 27th of July, excuse me, Mazda issues a press release saying that they're developing salvage plans, but they're going to wait to see exactly what's going on before they decide what they're going to disclose. A month later, the spokesperson, Jeremy Barnes, says, we don't have a count as to what's saleable and what condition they're in. It depends on what we find when we get in. So what I infer from that is that by the 27th of August, they still hadn't decided what to do. And they were still contemplating that they might end up selling the cars. And we go ahead to the end of the year, 15th of December, and this Autoblog publishes a report that says, you know, Mazda has been saying that, they've said earlier, I guess in communications with the reporter, that they would inspect all of the vehicles, and their idea was that they would sell as used with full disclosure. So basically, you could buy one of these cars at a discount, but you would get a little certificate that said, by the way, this was on the Cougar Ace, and it sat at 60 degrees for 3 weeks. Because these cars looked perfect. You look at them, they look absolutely perfect. No dents, nothing. Plastic all in place, everything looked perfect. However, on the same day, Mazda issues a press release and says, no, I know these cars look perfect, but we're going to destroy them. Okay, wow. Here all along, they've been talking about all of these other strategies, and they decide to destroy them. Now, if you look at their annual report, the external financial statement, what do we see? The only thing that we see is that Mazda records a loss on the value of their inventory of about 16.76 million US, or 3,566 per vehicle. Okay, so this is basically saying we cancel the cars, we're destroying them, so this inventory doesn't have as much value anymore, so we're going to write it down. Look at the amount that they wrote it down, 3,566. Now, what was the value that was lost? Do you remember? 22,000. Does this seem like a reasonable amount to write it down? Think of it. Car companies, They can build a vehicle for $3,500 and sell it for $22,000. That's one heck of a business. I'd like to, we should, John, we're in the wrong business. We should be building cars. I mean, clearly this is not correct because the auto business is a very competitive business. There is no way that the profit margin is that large. But that's what Mazda is claiming. Okay, in 2008, so now we're 2 years out, the Wall Street Journal publishes an article talking about the disassembly line. So how were they taking these cars apart and destroying them, and describing the loss of the $100 million worth of cars. It wasn't until May 6, 2008, almost 2 years later, that the last Cougar Ace was shredded. Okay, now, these are big things to store. Notice that they had been untouched for 19 months before the shredding process began. So they had to park these thousands of cars somewhere for 19 months before they started destroying them. And then even by 2009, things aren't done. We're still in the courts related to the insurance settlement. So you can see that this is a really very long-term kind of a process, which is going to have implications for the accounting. Okay, so what to do? What should management do? Well, we know that they decided to destroy the cars, but how did they make that decision? Because they had a lot of different alternative ways to think about dealing with the cars. So this is a basic model that we use for making decisions. You recognize the need for decision. Clearly we have a need. We have these cars. You generate alternatives, so what are we going to do with the cars? Then we have to come up with a way to assess them. Then we choose amongst the alternatives, implement it, and then analyze the feedback. Well, given the time tonight, I'm just going to focus on the generating the alternatives and assessing them. Okay, so here are the primary alternatives. There are lots of permutations, but these are the main ones. So we could sell the cars at a discount. So we could sell it to individuals. We could sell it to movie companies, something like that. We could donate the cars. So we could donate them to schools. As I said, for shop class, we could donate them to fire departments. Or we could destroy the cars. And this is a picture of actually blowing the airbags for the cars, which is something they had to do. Okay, so those are the alternatives. Now we have to figure out how to assess them. Now in class I have time to go over more in depth, but let's just do it at a very conceptual level. So we want to be sure when we make this decision, and when we assess the alternatives, that we look at both qualitative and quantitative aspects. So let's just list some of the big issues that they should have thought about, at least in making these decisions. Okay, what about selling the cars at a discount? Well, from a financial perspective, they aren't going to get as much profit off the cars. The cars are gone, but they're getting some money. At least they're recouping some of the costs that they've incurred in building the cars. And they probably don't have to discount them all the way down to $3,000. So the quantitative isn't really a big deal here. The question is the qualitative. Okay, what's the problem with selling the cars at a discount? Well, the problems in there out there. So what if there's some unknown problem that isn't detectable now? But the cars were sitting at 60 degrees for 3 weeks. They've got all kinds of fluids in them, including acids and other kinds of nasty fluids, and who knows if there really was any damage inside. So what happens if this is in the U.S., remember, that's part of the important part, because what happens in the U.S., if I'm driving down the street and I have an accident and I can find some little flaw in the car, what am I going to do? Sue the car company, right? I'm an American, what can I say? Okay, so this is a huge issue. There's potential liability, legal liability, reputation costs as well. So this is a huge qualitative cost. It's going to be difficult to quantify, but something that is clearly important. What if I donate the cars? Well, I don't have to incur any cost to destroy them. They're off my lot. I don't have to worry about them. I can get some really good public relations, right? Here I'm helping the firefighters learn how to fight fires or something like that. I may even get a tax deduction because of the donation. Really great PR. Potential negative problem, though. Well, what if there is a problem? There still is the potential for these don't. So what if a fireman says, oh, we got 2 of these Mazdas. We only really need 1 of them for our exercise tonight. I'm just going to take this home and I'm going to drive on it for a while until we do our next fire quenching exercise. And that fireman gets into an accident and ends up suing Mazda. Okay, so we could still lower probability, but we still have a potential of negative consequences. Now what about destroying the cars? No liability, right? We don't have to worry about these cars getting out there, being sold as new, being sold as not having been on the Cougar race. Okay, so I don't have any of those liability concerns. On the other hand, I have to incur the cost to destroy the cars. So I have to figure out how to do that. Now, destroying a car isn't actually all that easy. So think about it. These cars, I showed you the picture of the airbags. There are 6 airbags in most of these cars. You have to deploy all of those airbags in order to destroy the car. So what they actually ended up having to do is they had to hire an engineer to invent a special tool that would simultaneously deploy all 6 airbags at the same time. The other thing is that there was an insurance recovery, but the insurance company said no part of the car can be saleable. So they had to take like the aluminum wheel rims and they had to snip them into little pieces. They had to take the tires, they had to shred them. They had to just completely break down absolutely everything so that there was no way that anything would make it onto the market. So they had all of these costs associated with labor, because it's very labor intensive. They had to move the cars around to get them to different stations. To do the destruction, they had this research and development to develop these new tools. Very, very costly kind of an exercise. But they decided to destroy the cars. So clearly, the potential liability was really very dominant in the way that they were looking at this decision. Okay, so that's the managerial accounting aspect. Let's think about from an external reporting, where should we see this in the company disclosures? And there are 2 types of reports where we might see information. The first is this one. It's a corporate social responsibility report. And then the second one is the financial statement. We've already talked a little bit about the financial statement, but we'll talk a little bit more about that in a minute. Okay, what's a CSR report? Well, this is a voluntary report that a lot of companies produce to provide information about their environmental and social responsibility performance. Now, if you look at Mazda's CSR report, they include discussion of shipping, they include finished vehicles information, they include information about recycling, and they include information about resources recovered. So when these cars were all destroyed, they recycled a lot of this stuff. Clearly there was shipping consequences. Clearly, so they recovered some resources. But you look in the report, you find absolutely no word about the Cougar race. Nothing. And I compared the numbers between 2006 and 2007. The numbers that should have changed a lot because of the cars, no change, or at least nothing out of the ordinary. So how could they get away with this? Well, these CSR reports are voluntary. There's no standard disclosure that's required. There are some standards that are developing, but at this point we don't really have any required type of disclosure. And CSR reports don't have to be audited. So you don't have a third objective party looking at the information to make sure that it's correct. Now, a funny thing about Mazda's CSR report is they don't have an auditor, but they have what they call a third-party opinion statement. So they went to a consultant, and they had the consultant write it. If you just look at it without reading it, it looks like an opinion letter that you would get in if the thing were audited. But what does it discuss? It says, oh, Mazda's doing a good job of talking to its supply chain about managing some environmental aspects. They've established a carbon limit for how much emissions they want to have in their manufacturing processes. I wish that they would do it for their cars in use as well as in production. This is what the consultant says. So basically that's the kind of thing that's discussed. The interesting statement at the end of the letter is, these comments do not constitute a judgment on whether this report presents an presents accurate measurements and calculations, has any major omissions, or was prepared in accordance with generally recognized fair and appropriate production standards for environmental and other reports. So basically, the consultant's saying, I really can't say anything about the report, and I have no idea if it's correct or not. So it's actually kind of a very interesting statement to have, as opposed to what you would get if the report were audited. So clearly, there's no mention of cougar ace, and this guy didn't catch that. Wasn't even really looking for it, I guess. Okay, so that's one form of external disclosure. The other one is the financial statement. Now, we have to worry about timing here, because in accounting, as I said, it matters what we know when. So the question is, what should we start seeing in the financial statements from us? Well, we already have talked a little bit about it, but there are other places where we should probably see things. Now, how do we approach what we disclose in financial statements? Well, we have this underlying notion in accounting called conservatism. And the idea is basically that accountants are very, very conservative. We don't want to have people look at the financial statements and be overly optimistic. So what this means is that we tend to recognize bad news early and good news later. So what should we see? Well, clearly we've got some bad news. We're going to have these costs incurred to destroy these vehicles. So we already saw the write-down of the inventory. But we also have these future costs that are going to be associated with destroying the cars. Now, it doesn't matter that some of those costs are 2 years down the road. Because we're conservative, if we have an idea of what those costs are, we have to think about whether we recognize them now, even though they're going to be incurred in the future. So here are the fundamental things that we think about. So is the liability probable? So is it likely that we're going to incur the costs in the future? And then is it reasonably estimable? So can we come up with a reasonable estimate? Well, let's think about Mazda and these disassembly costs. Is it probable? And I say yes. I mean, we've already decided we're going to destroy the car, so it's probable. Is it reasonably estimable? Well, we talked about the decision process that they went through to figure out what they were going to do. So clearly they did a financial analysis. So I would argue that it's pretty clear they have a reasonable estimate of the cost. So it is reasonably estimable. So we should see a liability in the financial statements. Seems pretty clear in this case. We don't see one. Now why? How could they do this? Well, one possibility is, well, they do have insurance. So maybe the insurance and it's going to be cash coming in, and destroying the cars is cash going out, and if we net them together, they kind of wash out. But remember that accounting is conservative. We recognize bad news earlier than good news. So we're going to recognize the liability as soon as it's probable and reasonably estimable. What do we do about recoveries like insurance? Well, they actually have to be virtually certain before we're going to recognize them. Well, remember in the timeline, we were still in the law courts 3 years later worrying about insurance. So I would argue that the insurance payment was probably not virtually certain. Even if it was, according to accounting rules, because we don't want people to see the net number and have it net to zero and basically get no information. What accounting rules say is if you have a liability and a recovery, you have a liability and then you have the recovery. And then it's up to the reader to net the two. So what we should see is a separate disclosure of the liability and a separate disclosure of the insurance recovery. We don't see anything. Okay. And so we don't see the disassembly liability, and we never ever see the insurance recovery, which is really interesting because there actually is another insurance recovery that is recorded, but it's got a description of what it's for, and it has nothing to do with the cougar ace. So we never ever see anything in the financial statements that is directly linked to the recovery. So how are they able to get away with this? Well, this is mandatory disclosure pretty much, but they're using Japanese GAAP because this is a Japanese company. They have Japanese financial statements, and for that portion of the company, they report under Japanese generally accepted accounting principles. Now, Japanese accounting and Australian accounting is pretty similar. They're both based on international accounting standards, but it turns out that Japanese GAAP is a little bit looser. So the level of probability, so whereas in Australian statements, it would have to be probable and reasonably estimable. There's a higher level that's required in Japanese GAAP. But I would argue that we know what the liability is going to be, and we know it's going to happen. So I think even under Japanese GAAP, they should be recognizing something. And the insurance company should have been included as soon as it was recovered. So how did they get away with this? Well, they did have an auditor, but the auditor let them get away with it. Now, this would not happen in Australia, at least not without having some lawsuit. Because this is a very visible accident that happened. It's not like it was something that was inside that nobody knew about. It was in the newspapers multiple times, so people knew about it. So if it were in Australia, people would have known that this was an incident that happened, and they would have been looking for it in the financial statements, and if they saw an audited financial statement that didn't have this information, then they would have done some more investigation. So what would happen if this were recognized? Well, income would be lower than it was originally reported because there are all of these costs that are not being included. So what do we end up with? Well, some people would look at this and see a boat that has the potential to sink. But what I see is a possibility to go in and explore some really interesting accounting issues. Thanks.
Thanks, John and Naomi, for those really insightful lectures. Does anybody have any questions regarding these lectures or accounting and finance for our academics here this evening? Any questions? No? That's fine. So that draws our information session to an end. Please feel free to enjoy the refreshments. The selection and recruitment team are here to answer your calls. Your questions, sorry. And also Associate Professor Greg Swan at the back as well, too, who's the Program Director for the Master of Management Finance. Is here to take your questions. Cool, thank you.